Markets, get us up to speed on what's happening in Turkey and whether it's still on your radar.
It's still very much on our radar because it's been so volatile. Last week we saw perhaps the peak for the moment, over 7 to the dollar. The Turkish lira went. It got back down to closer to 6 now, but it's still in the danger zone for sure. It's still 60% weaker this year against the dollar. And the main reason why the lira did recover were perhaps sort of slightly underhand backdoor measures to tighten liquidity from both the central bank and the regulator, making it much harder to short, and more expensive probably and harder as well to short the lira. But that's how foreign investors who would want to come and reinvest in Turkey here but would not want the currency risk, it makes it almost impossible for them, or certainly a lot more expensive. So it could be counterproductive. So I think until the central bank addresses the real problems, which is actually getting on a proper rate hike rather than a backdoor one, then I think you'll find that the lira will continue to be very much under pressure.
Marcus, I want to bring in Damian Sassower of Bloomberg Intelligence. He heads our EM coverage here in New York. Damian, if you squeeze offshore currency swap liquidity, you're essentially making it difficult for me to hedge, and guess what? I might not be buying your local bonds. I might not be buying your equities.
Well, that's right. I mean, the Turkish lira, is down, 20% per year on average over the last 5 years. And if you're taking that out of the equation, you're not going to have any offshore investor whatsoever going near it, right? I don't think, though, we're at the point where they're going to do an actual rate hike. I think we're going to see them tap the late liquidity window. I mean, we've gone from now them allowing local banks to tap the 1-week repo rate. Now we're at the overnight rate. That was the implied 150 basis point hike that Marcus was referring to. We've got another 150 basis points of backdoor measures coming through, I would probably say, over the next few weeks ahead of the SEP 13 meeting.
Marcus, walk us through this. For those people who aren't that familiar with what's happening with rates in Turkey, I remember sitting down with Erdogan Baski, the former central bank governor. That was when we used to talk about independence in Turkey a whole lot more. There was talk about going to a single rate. Why do we have so many different interest rates that we follow in Turkey?
Well, they should try, actually, the central bank to normalise. They had, as Damian mentioned, switched to for a few months the late liquidity window, which they may again forced to. But they have a corridor of 3 rates, and they try to stick to the lowest rate, which is the 1-week repo. They've switched for a lot of now the banks borrowing on FX swaps to the middle one, which is at 19.25, but they could very easily go to the highest one, which is over 20%. And if you look at 2- and 3-year bond yields, it's telling you that the market is expecting, if not an actual interest rate hike, because they're trying to avoid it, then certainly that for market participants trading in the currency, it's going to become a lot more expensive. So with 3-year rates at 27.5%, there is clearly a lot more interest rate pain baked into the cake of Turkey.
Marcus, I do want to get your thoughts on what's happening with sovereign rates, because we had the downgrade on Friday by Standard & Poor's, and a good friend and colleague of ours, Mark Gilbert, writing about this ahead of the downgrade, that really technically the bonds in Turkey are already trading well south of where some of these credit rating companies are.
Which makes me feel a little strange why Standard & Poor's left their rating, they're cut by 1 notch. They left their rating on stable. I mean, in one place in the world that isn't stable at the moment, it's Turkey. Also, slightly surprisingly, Moody's, which has the ability, S&P sticks to a clear timetable with regards to Turkey on a sovereign rating, but Moody's has much more flexibility, chose to cut their rating by 1 notch right after S&P, though they remain 1 notch above. It's all a bit strange to the rating agencies. I think they're as much in the dark as the rest of us are, I'm afraid.
Damian, it won't be the first time we're talking about credit rating companies and some strange action relative to what's in the price and what the bond market and investors are thinking about. But just how divorced from reality are the credit rating companies at the moment from what is happening in Turkey?
Well, I think any sovereign rating analyst is going to tell you they're going to be the last ones to the party, right? I mean, they always say, don't look to us to be ahead of the markets. We're going to be reacting to the markets when it comes to country risk. However, what this means now, Turkey's in a weird place, right? Its sovereign U.S. dollar paid debt is not quite at distressed levels. So what that means is there's really, I've seen a lot of countries, Venezuela is just one, where it kind of hangs between that traditional long-only emerging market fund manager and the EM distressed community. And until we see those 5-10-year bonds trading below 70 cents on the dollar, we're going to be there for a while.